Thanks, Steve. Thanks to all of you, especially for coming out tonight to this town hall. It's really great to see so much interest in the Federal Reserve. And this is just a fantastic facility, I have to say. I wish I was able to sing, because I think that would take better advantage of what we have available here. But thankfully for you, that will not happen. So in a few minutes, what's going to happen is that Kurt's going to open up the floor to questions. And I hope that you'll use that opportunity to ask any questions you might have about the Federal Reserve, or the Fed, as it's more commonly known as, and I'm going to talk about more colloquially. And I look forward to our discussion. But first, a disclaimer. As you will hear shortly, I'm one of the 19 people who have the privilege and honor to participate in the meetings of what's called the Federal Open Market Committee, the FOMC. I'm not this year actually a voter on the committee, but I do participate in the meetings. In 2014, I will be able to vote again. FOMC meetings shape the course of monetary policy in the United States. But it's very important to understand that in my remarks today, I'm going to be telling you only my own views, and those perspectives are not necessarily those of any other FOMC participant. So with having made that disclaimer very clear, I do want to say that I think I can speak for everybody in the Federal Reserve System when I say that we're all saddened by the loss of life that's taken place due to the storm that hit the East Coast. And our thoughts are with those people there, and we hope that the recovery goes very rapidly and smoothly. Let me begin with some background about the Fed. So relative to its counterparts around the world, the United States Central Bank is a decentralized one. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., makes up the Federal Reserve System. Our bank, the Minneapolis Bank, represents the 9th of the 12 Federal Reserve districts. And our district includes Montana, the Dakotas, Minnesota, northwestern Wisconsin, the Upper Peninsula of Michigan. As I mentioned, the Federal Open Market Committee, the FOMC, is the Fed's monetary policy making body. It meets 8 times per year to set the course of monetary policy. All 12 presidents of the various regional Federal Reserve banks travel from their home districts to Washington to contribute to these deliberations, along with the 7 governors of the Federal Reserve Board. So in this way, representatives from different regions of the country have direct input into the setting of U.S. monetary policy. So Congress requires the FOMC to make monetary policy so as to fulfill 2 mandates: to promote price stability and to promote maximum employment. And I think this should be clear that both of these objectives, price stability and maximum employment, are Main Street objectives in the sense that they're intended to benefit all Americans. So promoting maximum employment means that the Fed is charged with doing what it can to ensure that Americans who want to work can do so. Promoting price stability means that the Federal Reserve is charged with keeping inflation close to a pre-specified target. Price stability ensures that when people write contracts in terms of dollars, like student loans or annuities, they have certainty about what those dollars are going to be able to buy in the future. Now, in describing price stability, I've made reference to a pre-specified target for inflation. And I haven't said what that pre-specified inflation target is. In choosing its inflation target, the FOMC weighed the costs of overly high inflation against the need to guard against potentially destructive negative inflation, so-called deflation. And this assessment has led the FOMC to pick an inflation target of 2%. And similarly, most central banks around the world have opted for a low but still positive inflation target so as to balance the cost of high inflation against the risks of low inflation and negative inflation. So the FOMC has these 2 goals, maximum employment and price stability. It acts to achieve these 2 mandates by influencing interest rates through the purchase and sale of financial assets. So when interest rates rise, households and firms tend to spend less and save more. The fall in spending puts downward pressure on both employment and prices. When interest rates fall, households and firms tend to spend more and save less. the extra spending puts upward pressure on employment and prices. So this is how the FOMC works to achieve its goals of price stability and maximum employment. Now, I've used the term interest rates, but of course there are many interest rates in the economy. Mortgage rates, student loan rates, corporate borrowing rates, and so on. The Fed does not directly intervene in all, most, or even many of these markets. Instead, Congress has restricted the Fed to trade in a small number of financial markets. Nonetheless, most economists agree that the Fed is able to influence almost all interest rates. The forces of competition in financial markets imply that the prices in one financial market necessarily influence the prices in most or all financial markets. And it's this interconnectedness that levers the Fed's interventions in a small number of financial markets into an influence on the economy as a whole. So, as I've described, the Fed's mandated goals, the goals that it's mandated by Congress to achieve, these goals are clearly Main Street ones, promoting maximum employment and promoting price stability. But as I've also described, the Federal Reserve acts to achieve those goals by engaging in trades in financial markets. And I think the public discourse about the Fed often focuses on our financial transactions in isolation. And the links back to our Main Street objectives are not always apparent. I think this disconnect is always problematic. But in the remainder of my remarks, I'll argue that it's especially so today. So with that as backdrop, let me turn then to the current stance of monetary policy. 5 years ago, in October of 2007, the Federal Reserve had under $900 billion of assets, mostly in the form of short-term treasuries. It was targeting a Fed funds rate, the short-term interbank lending rate, of just under 5%. So that's where we stood 5 years ago. 5 years later, the Federal Reserve owns nearly $3 trillion of the assets, so it's over 3 times what it was 5 years ago. And these assets are now mostly in the form of government-issued or government-backed securities that are longer term, not short term. It plans to buy still more of these securities over the remainder of 2012. It has also been targeting a Fed funds rate of under a quarter percentage point. Remember, I made reference to the fact that the interest rate that it was targeting was close to 5% 5 years ago. Now it's less than 25 basis points, to use a technical language, less than a quarter percentage point less technically. And that's been true for nearly 4 years now. And it anticipates continuing to do so through mid-2015. In the language of central banking, the Fed's policy stance is considerably more accommodative than it was 5 years ago. So some observers argue the Fed has done too much, has been too accommodative. And I strongly disagree with this comment. So these critics are certainly right that the Fed's actions, tripling its balance sheet, keeping the Fed funds rate near zero for years, are historically unprecedented. But it's also clear that the economy has been hit by the worst shock in 80 years. Over the past 5 years, Americans have lost jobs and a great deal of wealth. Relative to 2007, people remain uncertain about their future employment and their future incomes. Businesses, too, are less certain about the future demand for their goods. These changes and these uncertainties make firms and households less willing to spend. And so they push down on both employment and prices. In order to fulfill its dual mandate, promoting price stability and promoting maximum employment, the FOMC must offset these adverse shocks by making monetary policy more accommodative. So in light of this unusually large macroeconomic shock, I believe that it's misleading to assess the FOMC's actions by comparing its current choices to policy steps taken over the past 30 years. 30 years are considerably more tranquil. Instead, we have to assess monetary policy by comparing the economy's performance relative to the FOMC's goals of price stability and maximum employment. In particular, if the FOMC's policy is, in fact, too accommodative, that should manifest itself in the data through the inflation rate being above the Fed's target of 2%. And this has not been true over the past year. Personal consumption expenditure inflation, including food and energy, is running closer to 1.5% than to the Fed's target of 2%. But I think this comparison using inflation over the past year is at best incomplete. Current monetary policy is not designed to affect inflation over the past year. It's designed to affect inflation in the future, with typically thought to affect it with a 1 to 2 year lag. This means that we should always judge the appropriateness of current monetary policy using our best possible forecast of inflation, not using current inflation. So along those lines, most FOMC participants, the 19 people that I described who come together in the meeting 8 times a year, most of them expect that inflation will remain at or below 2% over the next 1 to 2 years. Given how high unemployment is expected to remain over the next few years, these inflation forecasts actually suggest that monetary policy is, if anything, too tight and not too easy. So let me wrap up before we open the floor up for questions. So in my discussion about the Federal Reserve, I've described our decentralized structure, and I've emphasized our Main Street objectives: price stability, maximum employment. And I see our structure and our goals as entirely complementary to one another. In my view, having people from around the country, the presidents of the various regional reserve banks, having them participate in monetary policy deliberations is valuable in ensuring that those discussions always put our Main Street goals at center stage. Unfortunately, public discussion about the Fed often centers on the financial transactions that we undertake to achieve our goals. I think this focus on our actions as opposed to our goals is always misleading, and is especially so right now. The FOMC has provided a historically unprecedented amount of monetary accommodation. But the U.S. economy is recovering from the worst shock that it's experienced in 80 years. And a historically unprecedented shock should lead to a historically unprecedented monetary policy response. We should always judge the appropriateness of the Fed's policies in terms of how the economy is doing relative to the 2 Main Street goals that Congress has set for the FOMC. And such a comparison does not suggest that monetary policy is currently too easy. Thank you very much for your time and attention. Looking forward to taking your questions.